This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rocky week, but is volatility here to stay? If you're looking for answers from corporate America, then you may want to hang on tight.
A Rust Belt revival, what Pittsburgh is doing to reinvent itself as a center for modern technology.
That's how he rolls. Meet the entrepreneur who started a sushi operation in his house and turned it into a fast-growing business. Find out how he made his millions. Tonight, a Nightly Business Report for Friday, June 17th.
Good evening, everyone, and welcome. A quiet day on Wall Street, but not a quiet week at all. Stock market volatility is back, and it may not go anywhere anytime soon. This week's ups and downs were caused by all of the global uncertainties we've been telling you about, including Great Britain's vote next week on whether to leave the European Union and the Federal Reserve's forecast of slow economic growth. The Dow Jones Industrial Average capped this rocky week with a decline of 57 points, finishing at 17,675. NASDAQ dropped 44, and the S&P 500 fell 6. For the week, all of the major indexes lost more than 1%. And concerns over slow growth may not bode well for one of the most critical forces in investing, corporate profits.
Forget the Fed. Set aside the vote on Britain leaving the European Union. In the long run, and probably the short run too, what matters most to stock prices is, yes, corporate profits, the mother's milk of money making. And the profit outlook, weak all year long, is getting worse. FactSet says U.S. corporate profits will likely fall more than 5% this quarter. S&P Global Market Intelligence thinks they'll slide 4.7%. If profits do decline this quarter, and there's only 2 weeks left to go, it'll make for the fifth such quarterly decline in a row. That will be the worst such skid since 2009 in the midst of the Great Recession. Make no mistake, lots of companies are earning plenty, just not as much as a year ago. Banks are one example. For them, profits are simply harder to come by in today's highly regulated, low-interest rate world. Ditto energy companies, likely to show the biggest earnings declines from last year. There's not much glitter in materials and mining either, or, for that matter, in technology. Once the driver of corporate profit growth, tech companies overall may make less this quarter than they did last year. One contributor to the slide, amazingly, is Apple. Sure, it's making tons of money, just not like it used to. So get ready, folks, for a lumpy, bumpy run of corporate profit reports as summer heats up.
John Butters joins us now to tell us what he expects when companies start reporting their second quarter earnings results a couple weeks from now. He is senior earnings analyst at FactSet. Welcome. Nice to have you here, John.
Great. Thank you for having me.
So that is the question. I mean, there are pretty low comparisons for some of these companies, certainly, but, we left off with a bumpy earnings season ahead. Would you agree with that?
Exactly. It's interesting. If you look at how analysts have revised their estimates, though, companies and analysts have been a little bit less pessimistic than normal coming into this earnings season. So as you noted, we are expecting the decline of 5% year over year in earnings for the second quarter, and that's larger than the decline of 3% expected at the beginning of the quarter back on March 31st. However, a 2% drop is actually a smaller drop than normal in terms of estimate cuts. Typically, we see about a 3% cut. And the reason for that is really the energy sector, which is a little bit surprising. In quarters past, we've seen analysts slashing estimates across the board in the energy sector. But this time around, analysts have actually raised their expectations slightly. We've seen about a 1% bump in expectations for earnings. So, if we look at companies such as ExxonMobil and Chevron, both have seen numbers come up during the course of the quarter.
So maybe not as bad as earlier in the quarter, in part because oil prices have gone up. Give me some good news here, John. Are we anywhere near sort of the bottom of this trough in corporate earnings? In other words, might this be the worst, and might it start to improve afterwards?
Well, based on analyst expectations, this will be the last quarter of year-over-year declines in earnings. As you noted, this quarter, if we do finish with a decline, will be the fifth straight quarter of year-over-year declines. But starting next quarter in Q3, analysts are looking for growth of 1%. And then in the fourth quarter, that jumps up to 8%. And in the second half of 2017, we're looking for double-digit growth. And again, the main reason for that is the energy sector. And there are two reasons. One, the comparisons for earnings get a lot easier as we move into the second half of this year and into next year. As you know, our energy earnings have been weak for the last year.
Absolutely, yeah.
So the comparisons get easier. And the second factor is analysts are expecting the price of oil to increase over the next year or so, and earnings estimates typically correlate with oil prices, so analysts are calling for higher earnings. So again, higher earnings estimates, easier comparisons, and energy is really a driver of the expected growth going forward in the second half of this year and into early next year.
So let's talk sectors that you're expecting to see the highest earnings growth for the second quarter. Telecom is one of them, and basically there are a couple of companies in there that have done deals.
Exactly. So overall, just 4 of the 10 sectors are expecting growth this quarter. As you said, the telecom services sector is expecting the highest growth at 8%. And in that sector, really AT&T is driving the growth, and that company is benefiting from its acquisition of DirecTV from last year. If we take AT&T out of the sector, that 8% growth drops to a decline of 4%. So again, you can see AT&T really the driver of growth in the telecom services sector.
Can we quickly go through the laggards?
Yeah, go through the laggards. And I was going to ask, what's tripping technology?
So if we look at the sectors expecting the lowest growth, again, energy sector, we've talked about that, a significant decline of 75%. And although, as I said, the estimates have come up on a year-over-year basis, you're still looking at a significant decline. The sector expecting the second highest decline is materials, down 11%, weakness in metals and mining there. And the third is technology, as you mentioned, that's expected to be down 7%. And a lot of the weakness there can be attributed to Apple. And the reason for that is lower iPhone sales. As we know, iPhone is one of the main drivers of revenue growth for Apple. iPhone sales expect to be down 20%. So Apple expecting to see a decline in earnings overall. We take Apple out, that 7% decline for tech improves to a decline of 2%. So again, energy, materials, and tech, the weakest sectors.
On that note, John, thank you. John Butters with FactSet. Ty?
A Fed official today made a significant shift in his outlook for the economy. St. Louis Fed President James Bullard says low economic growth will likely remain in place through 2018. And he forecasts just 1 interest rate hike between now and then. This is a reversal in thinking for Bullard, who previously said growth would pick up and rates would rise. He now says the long-run outcome or outlook for the U.S. economy remains uncertain.
We've been reporting on the risk of the UK referendum and what it poses for the market and the economy. And in an interview today, the head of the International Monetary Fund said the outcome of the vote is a concern for the entire world.
It's going to cost, it's going to be negative for income purposes. It is going to be reduced trade, most likely as a result of uncertainty. I mean, those are blatant facts.
Lagarde went on to say that being a member of the European Union has enriched the United Kingdom's economy.
So which U.S. companies have the most at stake should the U.K. vote to leave the European Union? Wilfred Frost has our report.
There has already been a clear effect on U.S. bonds, the yield on the 10-year declining from over 1.9% to below 1.6% in the space of a couple of weeks. But while European equities have declined sharply over the last 10 days, the DAX down around 5%, US equities have been more resilient, the Dow down just under 1%. But what about US companies with high UK exposure? Some big names like Ford, eBay and PPL Corp appear in the top US companies based on UK sales, and thus will be affected by UK growth slowdowns as well as falls in sterling as they report earnings in dollars. However, most of this top 10, their sales are predominantly within the UK, so would not really be affected by renegotiations of trade deals between the UK and the EU, and thus not face a potential collapse in sales. What about a sector basis? Well, banks are likely to be the worst hit. As a whole, the UK has a trade deficit with the rest of Europe, making retaliation less likely. But within just financial services, it has a big surplus, making it the area most likely to see tough and vindictive response in future trade negotiations. Of the top 5 US banks, Goldman Sachs has the highest exposure to EMEA at 27%, Bank of America the lowest at 7%. But of course, the biggest impact of Brexit on banks has already happened, delayed rate hikes and lower yields. For Nightly Business Report, I'm Wilfred Frost.
Still ahead, big changes are coming to Costco, and millions of shoppers will be affected.
The Justice Department has reportedly abandoned its case against the former head of Countrywide Financial. As first reported by Bloomberg, prosecutors have decided not to pursue charges against Angelo Mozillo, a pioneer in the risky subprime mortgages that were at the center of the financial crisis. The decision draws to a close a 2-year quest to bring a civil suit against him.
Beijing's patent regulators have ordered Apple to stop selling its iPhone 6 and 6 Plus in that city. The ruling says the design violates patents held by a Chinese company. But Apple is appealing that ruling, and the company says it will continue to sell those iPhone models in the world's second largest economy until the appeal works its way through the system.
A big switch is about to take place for millions of credit card holders, and if you plan on heading to Costco, you'll need to check your wallet to make sure you have what you need. Kayla Tausche explained.
Planning to use a credit card at Costco? Well, starting Monday, you'll need a new piece of plastic. For the first time in nearly 2 decades, Costco's 11 million credit card holders will be bearing a Visa card issued by Citigroup, replacing the American Express card that Costco exclusively accepted before a bitter fallout. While customers aren't shy about their brand loyalty, most seem unfazed by the switch.
Well, I prefer American Express, so I'm sad by it.
I have multiple Amex cards, but the benefits are becoming less, and it's better now with the other cards. So I'm looking more into using my Visa card.
I think more people carry the Visa card. American Express is a little pricey.
I don't like it at all because I use American Express for everything.
My son is happy about it because he only holds a Visa and a MasterCard, so he's happy about it because he has to always go in with cash.
I don't think it will affect spending one way or the other. I think it's just a matter of probably Costco having negotiated a better deal for their customers with Visa.
That's exactly it. The new card gives customers much more cash back. City Executive Judd Linville said Costco's executives were involved in everything, down to the graphics.
As we talked about how do you construct something like this, they were willing to also go in to say, hey, we're in this with you. We want to make this product the best. And so you can imagine that can make negotiations and some of the financials perform a little bit different.
American Express called those new terms uneconomical, and the two companies still can't decide who exactly broke up with whom. But breakups can be messy when they're with your single biggest customer, in Amex's case. It's now trying to get Costco shoppers to sign up for a new Amex card, and former customers still owe the company around $12 billion in Costco card balances. But all spending from Monday forward goes to Citigroup and Visa, whose other Visa credit cards will be accepted at Costco too. That is a first. And if you've been wanting to sign up in store for a new Costco card, maybe wait until after next week once the dust settles. For Nightly Business Report, I'm Kayla Tausche in New York.
Viacom lowers its earnings guidance for the first time since 2008, and that's where we begin tonight's market focus. The media company expects earnings for the current quarter to fall well below Wall Street targets. This is due to the disappointing performance of the latest Teenage Mutant Ninja Turtle movie. The media company also blamed the ongoing management dispute for a delay in completing an on-demand video agreement. Shares of Viacom down more than 1% to $44.42. Government regulators have closed their investigation into Lumber Liquidators' Chinese-made laminate flooring. The Consumer Product Safety Commission said no unsafe formaldehyde levels were found in the flooring during its tests conducted in thousands of homes. In addition, the company has agreed to not sell any remaining inventory of that product. Shares surged 19% to $15.78.
Satellite TV provider Dish Network has dropped 2 channels owned by the National Football League. The 2 companies failed to reach a new distribution agreement. The NFL Network said this is the first time a service provider has blacked out the network to subscribers. Shares of Dish little changed, ending the day down a tick at $53 even. Synaptics, which makes touchscreen parts for Apple's iPhones, plans to lay off 9% of its workforce and shut down some of its offices. This according to a regulatory filing. In addition, the company's CEO has requested a temporary reduction in his base salary of 20%. When's the last time you heard that? Shares plunged nearly 11% to $53.85.
This week's Market Monitor likes strong growth companies he says can do well in any macroeconomic environment. This is his first time joining us on the program. He is Joe Dennison, portfolio manager at Zevenbergen Capital Investments. Welcome. Nice to have you here.
Thank you. Great to be here.
Joe, you also mentioned that you want founder-led, company-centric business models, correct?
Yes, that's correct. We love strong growth companies, like you said, customer-obsessed, founder-led. We find that founders have a much longer-term vision, and over the long term, it's this revenue and earnings growth that drives stock prices.
Let's start with your first pick, and that's Netflix. Why do you love it?
Sure, Netflix, we think it's clear that all TV is moving towards on-demand streaming. Millennials like myself are not going to schedule our lives around primetime viewing windows, and Netflix is the clear global leader. They've got the largest, most compelling content library and a differentiated economic model that doesn't rely on advertising. U.S. business proves the model can work profitably and now launched in 130 countries this year. We think subscribers and material profits will follow.
Okay, founder-led kind of defines your next pick, which is Tesla. To put it mildly, you've owned it since the IPO.
That's correct. We've owned Tesla since the IPO in 2010, and skeptics at the time didn't think they could build a single car from the ground up. And here we are today, the clear technology leader in electric vehicles in a market where we haven't seen a competitor bring a compelling product to market yet. Just this year, the company launched their Model 3 mass market vehicle and saw pre-orders vastly outpace any expectations. The $17 billion in revenue potential from that is more than double the best iPhone release weekend in history. So it comes down to execution, and we'll continue to put our faith in the management team that's hit on all of our targets so far.
You know, you can go ahead and not schedule your life around television, except for nightly business report, okay?
That's right.
Joe, you'll do that, all right? I don't even know whether we're
it's on
Netflix.
The DVR.
Your third is called XPO Logistics, not a company I know much about.
Yeah, XPO Logistics, another example of a strong management team applying technology to an old industry. They're a third-party logistics provider consolidating a very fragmented market, layering in their technology to rapidly take market share. CEO Brad Jacobs has proven success with a similar business plan rolling up United Waste and United Rentals. Key driver for the company is the shift of shopping online. As more and more goods are sold online, the shipping complexity and demand has risen significantly.
Okay. We got to go. Thank you so much for joining us. Great to have you on the program. Joe Dennison with Zevenbergen Capital Investments.
Coming up, it's no fishtail. Meet the entrepreneur who started with nothing and built a sushi empire. It's tonight's episode of How I Made My Millions.
Oregon wants to ban trains from carrying oil through its state. Though there were no injuries in this Union Pacific train derailment last month, which was transporting North Dakota crude oil, it did spill into the Columbia River and people had to evacuate their homes. Oregon's Department of Transportation has asked the Federal Railroad Administration for a moratorium. Oregon is the first state to ask for such a ban.
Philadelphia became the second American city to institute a tax on soda. The city council yesterday passed a 1.5 cents per ounce tax on sugar-added and artificially sweetened soft drinks. That adds 18 cents to the cost of a can of soda. The new tax will go into effect January 1, and it is expected to raise $91 million a year in revenue.
Well, across the state in Pittsburgh, you might expect to find steel companies. But instead, there are startups, a growing number of them. And as Kate Rogers reports, businesses large and small are helping to reinvent the Rust Belt.
I'm charging with every step that I take right now?
Yes.
While devices from tablets to cell phones improve constantly, the same can't be said for their battery life. It's something 25-year-old Hannah Alexander and her startup Soul Power are out to change.
We make energy harvesting insoles for charging portable electronics like cell phones, radios, and GPS while you walk.
Soul Power has raised around $500,000 so far and is being tested by the U.S. Army. But Alexander isn't alone in her desire for change. Other startups vying to solve some of the world's big problems are doing so not from Silicon Valley or Alley, but Pittsburgh. The city, once a booming steel town, has turned around post-industrial collapse, but never lost its spirit of innovation. Pittsburgh is already home to offices for Google, Apple, and most recently Uber. But in the past decade, its startup scene, bolstered by tech companies, has taken hold. The Iron City is also one of the most affordable places to live and work in America. That's part of the reason why the Kauffman Foundation has ranked this a top 10 metro for established Main Street business activity, with more than 1,100 small businesses for every 100,000 residents in the area. Innovation Works, a nonprofit with 2 nationally ranked accelerator programs, has invested $65 million since 1999 in 300 local companies. They've gone on to raise more than $1 billion. More broadly, in the past 2 years, Pittsburgh tech companies have raised nearly $500 million in VC funding.
We track entrepreneurs that come to us for help, and that number has literally gone up over 400% or a 5-fold increase just in the last roughly 8 years. So a lot of momentum.
One of those startups was launched by native Ian Rosenberger, who started his company Thread in 2010. They take recycled plastics from Haiti and Honduras and turn them into sustainable fabric. The company's raised $2.8 million and has a deal with Timberland.
We could have started a business anywhere in the world, and we chose Pittsburgh. We care about who we are as a city. We care about, our uncles and our dads and our grandfathers lost their jobs at the mills in the 70s and 80s. But in the ashes of that, you see this incredible ecosystem of businesses that are starting that mean something.
For Nightly Business Report, I'm Kate Rogers in Pittsburgh.
To read more about America's new Rust Belt, head to our website at nbr.com.
And now an entrepreneur who's on a roll. He immigrated to the United States with little money. When he got here, he found a nation hungering for sushi. So he figured out a way to feed it, building a franchise operation that is now a multi-million-dollar enterprise. His rags to riches story is tonight's How I Made My Millions.
Charlotte, North Carolina, miles from the sea, is not exactly the place you'd expect to find a sushi empire. But that's exactly what you will find inside this 46,000 square foot warehouse. It's the home of Hisho Sushi, a dynamic food service and distribution company that manages 884 locations in 39 states and the District of Columbia.
Don't forget your napkins, chopsticks, soy sauce.
The big fish in the operation? Philip Mong, the founder and CEO of Hisho Sushi.
Oh, okay. Can I test a sample? People think I'm a workaholic, but I don't feel like it's work.
Whatever he's doing, he's got Hisho on a roll.
I like it, spicy.
Bursting with 372 employees and more than 360 franchisees across the country. Most immigrants, like Mong himself.
When I came here, I have no one to help me out, so I decided to help out the newly immigrant. So how's the training go?
Before putting them behind a counter, Mong makes sure his managers and sushi chefs-to-be learn the subtleties of perfect preparation.
Practice more, you will get it.
All right. It's the type of specialized training he never received as a young boy, living in a country shattered by war.
I was born and raised in Baltimore. We treat it as like a second citizen.
So he set his sights on more fertile ground.
I decided I'd like to come here and look for the American dream.
In 1989, at the age of 22, his parents staked him to an airline ticket to Los Angeles with only $13 in his pocket and a wealth of ambition. He stayed with a friend, worked overnights at a gas station, and then became a real estate agent before landing a job with a sushi distribution company in the 1990s. He learned the business from the inside out, and after just 1 year, Mong and his wife moved east. They borrowed $100,000 from family and friends and took cash advances on credit cards to start their own sushi business headquartered in their home.
We set an office here and with the one computer and one tiny printer for about years before we get into the formal office.
They partnered with local retail locations to offer fresh food daily to grocers and cafes. Then in 2002, their first big break. A partnership with Minnesota-based supermarket chain Lund Food Holdings. Together, they placed sushi kiosks in 21 locations. 3 years later, Hisho was able to move into its current headquarters with a freezer that holds up to $1 million worth of frozen product that's shipped across the country every single day. It's also the home of Hisho University, the exclusive training ground for the company's managers, chefs, and franchisees.
And make sure you train your chefs to only use 1 ounce of rice.
After finishing the program, the company partners with the trained chefs and places them in locations across the country and splits the profit 3 ways. The chef or franchisee, the retail landlord, and Hisho Sushi.
Which one the most popular?
They really love this one.
The formula seems to be working big time. Company revenues were close to $100 million in 2015.
That's the most beautiful sushi that I ever seen.
Philip Maul, Burmese immigrant turned sushi magnate, has clearly learned the basic lesson of American business.
Listen to the customer. Do whatever it takes to make the customer happy.
The customer is always right. The customer is always hungry. Exactly. Hisho Sushi. Say that 5 times fast. Those kiosks can be found in specialty supermarkets, hospitals, airports, and universities. About 80% of the employees are immigrants, and the company says they are all in the U.S. legally. And I'm hungry, and I would like...
We both are, but it's beautiful food, isn't it?
Beautiful food. Piece of art.
So pretty. It's nice to have you back, by the way.
Good to be here, and you're going on vacation. Have a great vacation.
So it was fun to see you for one day. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And I'm Tyler Matheson. Have a great weekend, everybody. Have a great Father's Day, fathers.
Absolutely.
We'll
Happy
see you.
Father's
Thank you.
Day.
We'll see you Monday.